Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Welcome to this episode of Provident Healthcare Partners podcast. Today we'll be talking about the due diligence phase of the transaction. This is Ajeya Shekar. I'm a vice president with Provident. On with me is Leiba, senior managing director, who's based in Las Vegas, Nevada, and Scott Davis, who's a vice president and here with me in our Boston office. And this is a common topic that we run into on a day-to-day basis, managing the due diligence process from start to finish. If you're an independent healthcare organization and you've just signed a letter of intent to be either acquired by a strategic partner or a private equity firm, there's typically a phase of the process which involves the buyer coming in, examining the books and records of the business, structuring the legal aspects of the deal to the close. And it's a process that not all organizations go through on a routine basis. So the purpose of this podcast is to essentially walk our listeners through what to expect when going through this due diligence process. Scott, maybe you can help our listeners just get a 30,000 foot view of what the due diligence process looks like.
Sure. So just taking a step back in the process and taking a look at where you are in the overall transaction, the seller will have just executed a letter of intent with their preferred partner. Within that letter of intent, there are a number of variables, of course, the most important being the overall valuation, but one other is the period of exclusivity. We typically see that this runs from 90 to 120 days, and what that means is you're essentially committing to all negotiation efforts and execution efforts being guided towards this one partner for that period of time. Therefore, you have to cut off any negotiations or discussions with other third-party investors for the duration. Due diligence is a vital step in the overall transaction process, especially in regard to privately held companies, because they're not subject to the same scrutiny of public entities. Obviously, as a public entity, there are much higher regulations in terms of what level of transparency you have to provide to the market, and therefore, information is more readily available in those situations. Due diligence is especially important in the healthcare industry, given the highly regulated nature of the industry. The clinical components especially are highly regulated and therefore involve an extra level of scrutiny by investors. Rebecca, what other aspects of the overall diligence process do you think are important?
So what's important here to recognize is that the buyer needs to ensure it knows exactly what is being purchased and what obligations they'll be assuming. The availability of complete and accurate due diligence is one of the most important components to a successful transaction.
Great. And just for our listeners' sake, what's involved in the due diligence process? And from your experience as an investment banker, Rebecca, how can an investment bank aid in helping clients get this deal over the finish line?
So due diligence consists of a review of the seller's contracts and agreements, their financial statements, and any other material documents with the purpose of painting a complete picture of the seller's business and assets, the good, the bad, and the ugly. Diligence is typically broken into financial diligence, legal due diligence, and operation or business due diligence.
And Scott, maybe start with the financial due diligence phase. What's involved in that process?
This is typically the first aspect of an overall diligence process, and the reason being the valuation itself is, of course, predicated on the financials your investment bankers and company have put forward historically, and therefore it's the first thing that wants to be evaluated by an investor. If for no other reason, they want to make sure that the business that they're intending to purchase is what it says it is from a historical perspective, but also doesn't incur other diligence costs to that investor before having confirmed that. A buyer will conduct a comprehensive review of historical financial statements and related financial metrics to develop an in-depth understanding of the performance and condition of the business, as well as expectations for future projections. This is typically led by a third-party accounting firm, and the most common exercise they conduct is called the quality of earnings analysis.
And what sorts of trends are they looking for in the business from a financial perspective?
There are various aspects that they'll evaluate. I would say some of the more common ones that are touched on are margins. Are those growing or deteriorating? Future projections, are they reasonable and attainable? Are there outside market factors that need to be considered? What capital expenditures or investments may be required for the business? And also doing a cash to accrual conversion is a key component to an overall financial process.
And so, Rebecca, the second phase you mentioned was the legal aspect of due diligence. Obviously, I think most CEOs and business owners understand that the lawyers, experienced lawyers, are crucial to this process, and as a result, very well compensated for their work. Could you help us understand what goes into the legal phase of the due diligence process overall?
Yeah, that's right. So a buyer will conduct a regulatory review in order to confirm that the seller's been operating in compliance with federal and state fraud and abuse laws, to review the conditions of participation and reimbursement requirements for Medicare, Medicaid, corporate practice of medicine prohibitions, fee-splitting prohibitions, federal and state privacy and data security statutes and regulations, and state licensure and certification regulations, which govern both professionals and the entities. Through the due diligence process, the buyer can identify the regulatory risks associated with the acquisition, and that will shape the structure of the transaction, as well as the negotiation of the acquisition agreement. The buyer needs to identify any potential liability with respect to some of these matters because they can survive the closing of the transaction, irrespective to the structure. Due diligence essentially puts the parties on notice as to material issues and informs the drafting of the comprehensive closing documents. By identifying the key healthcare compliance issues during the due diligence process, a buyer could also require a seller to take remedial action prior to the closing of the transaction. The parties may even restructure a transaction based on the regulatory due diligence findings to limit the transfer of liability from the seller to the buyer. In addition, both buyer and seller counsel will create a new legal entity structure for the combined entities post-close that's both compliant from a regulatory perspective, but also tax efficient and growth-oriented. Key contracts may also be reviewed in order to determine assignability and consents needed on a post-closing basis. All of this with the purpose of ensuring a smooth closing and a successful post-closing operation.
Those are all really good points, Rebecca. One other thing that we always see pop up as a major component in legal diligence are the disclosure schedules. I know those are worked on right up until the day of close. Where would you say this fits into the overall puzzle from a legal perspective?
So the diligence process is used to drive the disclosure schedules. The disclosure schedules are an attachment to the purchase agreement with the purpose of listing exceptions to a seller's representations or to provide supplemental information called for by the purchase agreement. The diligence encompasses financial, legal, coding, HR, insurance, IT, real estate, and background checks, and all of this information is captured in the final disclosure schedules with the purpose of legally putting the parties to a purchase agreement on notice as to the material issues and facts about the seller and its assets. Disclosure schedules benefit the seller and can save them from costly post-closing disputes.
Yeah, I think those are all good points. And, from our experience at Provident, having gained a good understanding of the business over time, working with them from a pre-transaction engagement perspective all the way up until close, we actually take on a lot of those disclosure schedule creation processes ourselves, just to add value to our clients and also create efficiency throughout the deal process from start to finish. And even, in the due diligence process, there's a lot of kind of rapport building exercises between the seller and the buyer, such as creating, a 100-day plan to think about what steps we need to take to integrate these businesses post-close. How can we effectively target acquisition targets and growth opportunities? So even all along, there tends to be more of this qualitative aspect of the due diligence process as well. I guess, just to kind of sum up, Scott, what are some of the ways a company can best prepare for a transaction process, even if it's not something that is on the immediate horizon?
Yeah, this is a tough one because many businesses will never go through such a process. And so to be prepared for something that you don't foresee in the future can be tough. But nonetheless, our experience lends itself to knowing some of the common pitfalls or areas that can delay an overall diligence process. And so some examples of that, I would say, are just simply having corporate documents and contracts well organized. For a business that's 20, 30, 40 plus years old, it's not uncommon for various documents to kind of fall through the cracks, whether those are organizational documents, leases, contracts with key employees, anything of that nature that just isn't top of mind or something you evaluate on an annual basis necessarily can fall through the cracks and can be timely to obtain. So just making sure that those are in a place that are concise and in a neat, organized fashion and being able to provide those to an investor can be a major time saver in a diligence process. I'd also say routine examination of internal processes from billing, HR, accounting, and really any other major function of the business can be important. And I specifically mentioned the accounting practices of a business because it's such an important part of the overall valuation for the business itself. Of course, the valuation is predicated on what the productivity of the business is, and therefore having good steps in place and processes in place from an accounting perspective to ensure that the valuation you've received at a letter of intent can then be memorialized at a close. A good way to prevent such issues from arising in our due diligence process is using third-party financial groups to evaluate your numbers on an annual basis. Whether that's a review or a formal audit, any of those steps can ensure a more cohesive QV process when the time comes. I would also mention having experienced advisors across the board can be a big added advantage in a due diligence process. Whether that's accounting, tax, legal, or investment bankers, all are a key component to the overall process. From an accounting perspective, as we just covered, ensuring that the financials are done on a routine basis annually and in a concise form will ensure a close. From a legal perspective, having somebody with experience not only in M&A, but specific to your industry, in this case healthcare, is extremely important. And lastly, investment bankers that can drive value and be involved in the process from day one to a successful close is extremely important.
Great. I think those are all good topics and insights from you both. And what we'd welcome from our listeners is any feedback or comments about additional aspects of the due diligence process that you'd like to learn about in more detail. You can always reach out to us at podcasts@providenthp.com for any ideas or suggestions, or leave us a review on our iTunes page. In the meanwhile, very much so appreciate everyone taking the time to listen here today and look forward to a future podcast.